So we know that the maximum deduction for charitable contributions is limited based on one, the type of charity you're contributing to, public, private, and then within that private foundation area, those that qualify for pass-through or don't qualify for pass-through. There's also a limitation based on the type of property that you're donating. So we're often, when we think about making donations, we just assume we're donating cash, which is a perfectly logical assumption. However, oftentimes it makes a lot more sense to donate something other than cash, and we'll talk about that. But let's start with cash, because cash is simple. If you're making a donation of cash, it is 100% deductible up to the limits specified by the type of charity that you're contributing to. You get 100% of the credit for that contribution if you get no benefit for that contribution. Like a dinner fundraiser, for example. If you do get some kind of benefit from the contribution, then it's a partial deduction if the gift exceeded the fair market value of the thing that you received in return. So if you give $100 and the value of the breakfast they gave you was $30, then your net contribution would be $70. We can ignore like coffee mugs and stuff, like when you give to NPR and they offer you some sort of a pen or pencil and whatever. And then the last area of cash gifts that results in zero tax deductions are gifts to colleges, where you get the right to purchase athletic tickets, which, of course, we're all familiar with. Moving on. The next area of gifting, which you might be tempted to do, would be gifts of service, which unfortunately, gifts of service really aren't deductible, with the exception of any out-of-pocket expenses you incur along the way of providing those donated services. For example, if I wanted to give hourly financial planning services away to teachers in Ashland, Wisconsin, because I just want to benefit teachers in Ashland, Wisconsin, I actually couldn't deduct the value of my hourly planning services. So even if giving them the same service I would give a paying client, I am not allowed to deduct the value of my services that I'm giving away, for a bunch of reasons. You can probably think about why that would not be smart for the IRS to allow. However, I could deduct the cost of the handouts that I provide them. So if I go to Kinko's, make a bunch of copies, whatever I paid for that, I could deduct. And then there's ordinary income property. When we say ordinary income property, what we're talking about is property that, if sold, would result in ordinary income tax being due. This could include things like inventory. So if you are a 7-Eleven store and you've got a bunch of Twinkies and you donate those Twinkies, that's considered ordinary income property, because if you would have sold those Twinkies, you would have recognized income on the difference between what you sold it for and what you paid for it. And so those Twinkies that you donate, the deduction is going to be based on the lesser of its basis or the fair market value. So let's say that you paid 10 cents per Twinkie a wholesale, and you're going to turn around and sell them for a quarter. In that case, the adjusted basis would be the amount that you could deduct if you gave those Twinkies to charity. Another example of ordinary income property would be stocks and bonds that you've held for less than a year. Those are called short-term capital gains properties. Another example of ordinary income property would be a work of art created by the donor. My mother-in-law is an artist. In fact, now that she's in her mid-80s, it's really interesting because the kind of art she creates requires welders to participate, and it's quite a production. Anyhow, she loves her art. She loves making her art. She is a prolific, tireless artist, and she has a ton of art at her property. Priceless to her. However, there are fewer and fewer buyers for her art. So if she were to donate some of her sculptures, which she has, she would be required to limit her deduction for that contribution to the basis or the cost of creating that art. So the cost of the welder, the cost of the materials. Even if she thinks that her sculpture is worth $50,000, if it cost $500 to make, and this doesn't include her time, if it costs $500 to make, then she, as the artist and donor, would be limited to the cost of creating that art. And then moving on to capital gain property. So capital gain property would be assets that, if sold, would result in capital gains tax. So it could be stocks or bonds that are held for at least a year, tangible property like cars or art or real estate. Those would all fall into that category. And the deduction for capital gain property is its fair market value as of the date of the contribution. Recall that if the adjusted basis on this property is higher than the market value, you would not want to donate that. That would be dumb, because you could get a tax break if you just sold it for its fair market value and took the loss. So it'd be worth more as a loss than to donate it at its fair market value. There are some exceptions that convert capital gain property to adjusted basis. And that's, of course, as you recall, if you donated to a private non-operating foundation. That was this bottom corner here. And if you donate tangible property for an unrelated use, and there's a couple of examples of that in the book, one of which is about a guy who's got a valuable coin collection that is worth well in excess of what he paid for it. And if he contributes this coin collection to a local museum whose intent is to display the coin collection, then he's got a charitable deduction equal to the fair market value. However, if he contributes it to his church, it's hard to imagine a situation where the coin collection could be used for religious purposes. Therefore, he would be limited to its adjusted basis. Here's some additional examples, some of which we talked about already, that illustrate how, what these different types of gifts might look like and how they're limited. Other ways that you could give to charity would be to give them a bargain gift. And that includes some math that needs to be done, because sometimes when you sell something to charity at a bargain, you're going to have to recognize a proportionate realization of capital gains as well as a deduction for the bargain element. This slide provides an example of that, which maybe we should just walk through. So in this example, the donor sells his house that has a fair market value. Donor sells his house. Fair market value, which means that he could sell it today to a normal buyer, not a charity, for $100,000, and he paid $100,000 for it. So if he sold it today, he would have zero gain. But instead, he doesn't really need the money and he wants the deduction, and so he sells it to a charity for $60,000. So in this case, the bargain element is the fair market value of $100,000 minus the price that he sells it to the charity for, $60,000, equals a $40,000 charitable contribution. So Now let's look at an example where you sell an appreciated property to a charity. So in this case, you have a house with a fair market value of $100,000 and a cost basis, what you paid for it, of $30,000, which means you have a capital gain of $70,000. You decide that you're going to sell it to a charity instead. Whoops. For $60,000. So in this case, you sell it to the charity and you still have a charitable deduction for the bargain element of $40,000. But you also need to report the realization of some capital gains because you still made money in this deal. So let's figure out that number. So the gain realized is equal to the sales price of $60,000 divided by the fair market value of $100,000 times the fair market value of $100,000 minus the basis of $30,000. So in this case, the donor would need to report a capital gain of $42,000. So the documentation that's required to prove that you've made donations is different depending upon the size of the donation. If you're giving cash or, publicly traded stock or bond, they might just want a canceled check if it's under $250. Between $250 and $500, they want some kind of acknowledgement from the organization that you gave. Usually you get like an email or a letter after you make this donation. And actually the same is true all the way up to $5,000. But if it's property, if you gift property under $250, this would be like when you drive to St. Vinny's and drop off a bag of clothes. They want some kind of a receipt with with your name, the date, and the description of the property. For between $250 and $500, they want, again, an acknowledgement from the organization. Between $501 and $5,000, they want that plus records of how and when the property was acquired. It's an adjusted taxable basis, and you have to fill out a form. And then over $5,000, they want all of that plus a qualified appraisal. So property, anytime you're going to give property away, they're going to really amp up the requirements because you could make up a whole bunch of numbers when it comes to what your property is worth. And the IRS wants to make sure that you're entitled to that deduction.